Now, accounting cycle is defined as a series of steps performed during the accounting period by the accountant to analyze, first of all, record, classify, summarize, and report the useful financial information for the purpose of preparing financial statements. Okay, business transactions, recall, are measurable events that have a change and significant change in the financial condition of a business. That's our definition of a transaction. And recall that transactions are an exchange of goods for cash between a business and an external party, such as, let's assume, a sale of a book. It can involve paid-in salaries to employees, so on. A few things must occur. It must be a measurable change in the balance sheet equation, in either asset accounts, liability, or shareholders' accounts. And there should be a source document, proof that that business transaction has taken place. Now here are the 8 steps. Again, first we analyze business transaction, which we already looked at. Now we're going to record the business transactions in terms of debits and credits in the journal. And then we're going to post from the journal to something that's called a ledger. And from the ledger we prepare a trial balance, and from that we complete our financial statements. Then after that we must adjust the books and close them. And so that's what we do at the end. So in this video we're going to look just at journalizing. Now the journal is a permanent record in which we record in chronological order everything that happens, every business transaction that has happened. Think of this as a diary. Okay? The journal entry, you record the business transaction in the journal. You show the effect that transaction has on the accounts in terms of debits and credits. We always record first in the journal, and there's a particular way in which we record it. This is called, the journal is also called the Book of Original Entry. This is what a journal page would look like. We have the date, let's say October 26. Happens to be my birthday. Anyway, a transaction is, let's assume this business sold shares to its investors for $10,000. 2 accounts are affected, cash and capital stock or common stock. We always record the debit first and near the line, so we record cash. Close to this line here, debit, 10,000. And then we move in and we say, okay, capital stock is the account that is going to be credited, and we record it here. All right, let's say now we skip a line between transactions. So October 27th, we borrowed money from the bank. Well, 2 accounts. Cash goes up, debit cash, 6,000. Credit, notes payable, let's say, which is a liability, 6,000. Okay, October 28th, I earn revenue of 1,000. Cash goes up, 1,000. Revenue is always credited, and it goes up 1,000. Then I paid salaries. That was October 27th. October 28th, I paid salaries. Well, an expense account is always debited, so salaries expense, 600, and cash, 600. So you'll see each transaction is recorded by the date. Debits always first and close to the line here. Credits are indented, and you just put them in the debit and credit column. Skip a line between each transaction so it makes it easier to read. And you see this is a chronological recording of every business transaction by date and the effect the transaction had on the name of the accounts that were affected and by how much, and each transaction has equal debits and equal credits, and that's how we record in the journal.